Two of the world's biggest economies, the United States and China, are struggling.
Business activity in Shanghai was brought to a standstill for weeks.
Disastrous. I think there is no other word for it.
What's up, guys? It's Graham here. So throughout the last few weeks, there's been a lot of talk about China's failing economy, the collapse of their $7 trillion housing market, and the impact that's about to be felt throughout the rest of the world. In fact, I've covered those topics twice and outlined just how severely their markets were about to be affected. But I have to say, the more I researched, the more I began to realize that there are some rather serious global implications that are not being discussed, and it's worth bringing to your attention because it's already started to happen. Europe, for example, has begun to face a near complete oil shutdown as their dollar falls to its lowest level in 20 years. Global inflation is the highest it's been in decades. Tighter monetary policy threatens to cause a worldwide recession, and in the words of Ray Dalio, the times ahead will be radically different from those that we've experienced in our lifetime. So in an effort to break this down and get to the truth about what's really going on, let's discuss exactly what's happening, what this means for the entire economy, whether or not it's as bad as people say it's going to be, and what you could do about it to make money, or alternatively, I guess not lose money, depending on which way you look at it. Although before we start, if you appreciate the unbiased research that goes into making a video like this, it would help me out tremendously if you hit the like button or subscribe if you haven't done that already. Doing that takes just a split second, it's totally free, you can always change your mind later if you want to, and it helps out the almighty YouTube algorithm. So thank you guys so much, and also big thank you to Public.com for sponsoring this video, but more on that later. Alright, so when it comes to a global recession, you have to understand exactly what's causing it, or in other words, who's to blame? And to do that, we have the term globalization. See, even though every country has its own economy, currency, and supply for goods and services, over time it becomes more and more profitable to expand those services overseas and attach themselves to the country that they're doing business with. This allows them to gain a competitive advantage by manufacturing abroad, buying cost-effective materials, and gaining access to an entirely new demographic to boost profits. For example, more than half of Facebook's revenue is overseas. 67% of Apple's business is generated outside of the US, and even Tesla is collecting 25% of revenue from China alone. But it's not without a bit of a catch. On the one hand, this allows for the creation of new jobs, innovative ideas, and a higher standard of living across the entire world. Not to mention, if it were not for outsourcing, it's estimated that the cost of a US iPhone would be $600 more, and fabrics would sell for 2 to 4 times their current retail price. However, the downside is that since we're so interconnected throughout the entire world, the economic downturn of one country could create a domino effect throughout another, and another, until we all see a global recession like we're beginning to see today. So what's happening, and how is this going to affect all of you watching? Well, it's not just one country or one event that's to blame, but instead a multitude of factors all happening at the exact same time. And first, we should talk about the Russia-Ukraine war. Even though it's an incredibly complex situation, globally the invasion resulted in a sudden increase of commodity prices like oil and gas as production was disrupted. In addition to that, there were also other commodity exports being affected as well, including wheat, nickel, and aluminum, of which Russia is a big producer. The impact extends even further though, with Reuters saying that over 90% of US semiconductor-grade neon supplies come from Ukraine, while 35% of US palladium is sourced from Russia, meaning computer chip and semiconductor production has become even more strained. After all, these chips are integrated in everything from cars, computers, phones, video games, electronics, solar panels, or basically anything with a computer, and that's partially to blame for the skyrocketing costs of so many items that we use day to day, leading of course to second, higher inflation. After all, gasoline makes up a large portion of the consumer price index, and if oil keeps going higher due to international tension, that's going to reflect in our own inflation numbers and the inflation around the world. The same applies to the chip shortages coming from Russia and Ukraine, with used car prices being a perfect example. Year over year, the price of automobiles has gone up by nearly 40% due to labor, material, and supply chain bottlenecks, but just as they were beginning to come down, they went back up. And finally, third, we have higher interest rates. In an effort to fight inflation, the United States raised their interest rates at a slightly faster pace than the rest of the world, causing other countries to hold those US dollars as a safe store of value. However, as the US dollar rose in value from excess demand, it became more expensive for other countries to trade in those dollars, forcing them to print more of their own currency to pay for those items that cost more because of excess less demand for the US dollar because of higher inflation. But that is just one piece of the puzzle, and the next is a topic that's been recently gaining a lot of traction, and that would be China. They're one of the world's largest economies, responsible for manufacturing 20% of the items that we all use day to day, and they're at severe risk of complete financial collapse. Now, even though we could certainly point to restrictive policies, questionable business practices, and a lack of regulation, there are three main factors that have contributed to a global slowdown. First, the impact of a zero-COVID policy. This quite literally means that there is zero tolerance for the spread of COVID to the point where China will enforce strict lockdowns, maintain tight regulation, and do anything in their power to prevent their population from becoming infected. But as a result, their economy is expected to lose its ground. Production is slowing down. Supply chains have continued to be severely impacted from a backlog of shipping, and their growth is now expected to be non-existent. But if that's not bad enough, we have second, the real estate market. Fueled by excessive speculation, false promises, and almost no oversight, many of the largest real estate developers in China have filed for bankruptcy, leaving citizens to fend for themselves along with mortgage boycotts throughout the entire country. Even though it started with the property giant Evergrande, who's more than $300 billion in debt, within 4 weeks, more than 320 projects in about 100 cities were facing similar protests, roiling markets, and forcing authorities to corral banks and developers to defuse the unrest. Now, even though this doesn't have a direct correlation to the US housing market, many large institutions have increased their investment in China throughout the last 10 years, and China holds nearly $1 trillion worth of US treasuries. So if they sell to raise money for their own economy, then demand for those treasuries would fall substantially. And finally, third, we have production. The New York Post suggested that the slowdown in China is likely going to result in fewer exports from the United States, resulting in less demand, less product being sold, and a further slowdown throughout the global economy. It's even noted that China will fall far short of meeting its annual economic growth target of 5.5%, and we're starting to realize very quickly that the days of China's meteoric economic rise are long past. However, in terms of what we're dealing with today and how this could lead to a global recession, we have to talk about what's happening right now. Although before we go into that, while we're on the topic of investing, if you're looking to expand your knowledge in the market, learn new strategies, and understand why your stocks are moving in one direction over the other, our sponsor, Public.com, wants to help, because they're an investment platform that helps people be better investors. Whether it's through their active community feed, public live shows, or interactive town halls, you'll get timely updates on what's happening day to day, along with its impact in your portfolio. Plus, they're leveling up the entire experience with their first subscription offering, Public Premium. This allows you to get advanced data, custom company metrics, and expert analyst insights on the information that matters the most. For example, you're able to see recent company earnings, revenue, a breakdown per product line, and much, much more, making it easy to quickly gather research. There's currently a wait list, but people are gaining access every week, so download the app using the link down below in the description to claim your spot today. Not to mention, for a limited time, when you sign up for an account at public.com/Graham, you may get up to $10,000 depending on the amount you transfer from another brokerage. Feel free to check out the additional terms down below in the description, so thank you guys so much, and now let's get back to the video. Alright, so in terms of what's happening right now, flat out, inflation is a huge problem around the entire world, with several countries seeing double-digit increases year over year. That's resulted in households having to pay more money for goods and services, meaning there's less money left over to pay for everything else, driving down demand, growth, and production at a larger pace than anyone imagined. For example, two of Europe's largest economies, Germany and Italy, are already beginning to show signs of a recession. It's also found that this downward trend is already as bad as in the 2008 crisis, and this data doesn't yet reflect the current spike in energy prices, which are expected to put even more pressure on both people and businesses. That's resulted in the euro falling below the value of the US dollar for the first time in 20 years, with the fear that international tension would cause commodity prices to rise even higher and demand to fall even lower. Now, in terms of the United States, it's said that since 1955, the US economy has always experienced a recession within 2 years from every quarter in which inflation was above 4% and unemployment was below 5% as they are today. So in terms of what this means for you, your money, and the global economy, here's what you need to know. On a really overly simplified scale, it's easy to see how one falling economy could affect the demand of another while increasing the costs of another and causing a cascade effect throughout the rest of the world. In this case, higher energy costs result in higher inflation, which results in higher interest rates, which reduces demand, which increases supply chain shocks, and before you know it, we're in a global recession. To me, it's not rocket science that China's lack of growth would likely result in fewer US exports, less international investment, and less profit for the businesses that we invest in. But solving the issue is probably not going to happen anytime soon, and most likely it's going to serve as a reminder that each country will have to adapt for the option of producing their own materials in-house to avoid future shortages. Realistically though, it seems like the most plausible scenario is that both the United States and the Euro area experience near zero growth next year with negative knockoff effects throughout the rest of the world, which basically means the economy will need to cool off before pushing forward. But at least for the foreseeable future, it's probably a good idea just to cut back on what you spend, keep a diligent budget, save as much as you can, invest as usual, and stay employed, because most likely we're going to have to wait for these conditions to improve before the economy can continue growing again. And hopefully by the time that happens, it'll be in a way that benefits everybody. So with that said, you guys, thank you so much for watching. As always, feel free to add me on Instagram. Thank you so much for watching, and until next time.